Jason, buddy, I don't know if you know this, but it's 5:19, not 4:20. Looking a little glassy-eyed over there.
I wasn't even following you at first. I was like, I thought you were talking about the time. I was like, what day is it? Yeah, so I texted you this morning. I woke up with my eyes completely shut and crusted over this morning. I couldn't even open my eyes. Had to run them under hot water to get the goop out of them to be able to open them. And it turns out I have bacterial conjunctivitis in both eyes. So now with at least with the medicated drops, I'm feeling a lot better, but my eyes still look absolutely terrible. They're just bright red. So fun facts, I love a good worthless trivia for you, but like the typical viral conjunctivitis that we know as pink eye is called pink eye because it's more of the salmon colored. Well, when you get the bacterial conjunctivitis, it's known for its red color. So now it's like bright red bloodshot eyes, and I'm just trying not to touch them.
Well, I am glad that this is a remote show. I hope you feel better, but I'm delighted I'm nowhere near you. Ladies and gentlemen, this is the Pirates of Finance, where I guess we talk about bacterial conjunctivitis rather than markets. At least that's how we get started. We are the co-hosts, the usually incredibly handsome man across the screen from me, the young Hemingway, Jason Buck, the man who knows a little bit about everything. I am his co-host, Corey Hofstein. And this is the show that we talk about markets, finance, crypto, business, entrepreneurship, wealth management. And while we may talk about all those things, none of it is advice. None of it's tax advice, life advice, marital advice. I don't know. Advice of any sort. Seek professional help.
Speaking of marital advice, that's the thing when I came back from the doctor. My girlfriend's like, what the doctor said. And it said that you just been farting on me too much in the night. And that's why we can't have nice things.
Just hotboxing you. Just pull the covers up over the head.
By the way, you'll love this for our usually chaotic starts. In that 30-second countdown, I had the FedEx guy. I got a delivery in that 30 seconds. I was like, I'm gonna give me that box.
Did you really?
You saw him coming. I got it done within the 15-second countdown there.
I feel like there should be some sort of challenge. Like, how much can we do in that 30-second countdown and still get back to our seat? Can I get a lap around the house in,
God, so bad. I want to touch my eye so bad right now. It's driving me crazy. Like the left one, just like I just want to pick at it so badly. By the way, we also usually you and I run to the bathroom real quick before we jump on live as well. And you'll love this. While I was going to the bathroom, there was a hummingbird outside of my back window. And fun facts about hummingbirds. Do you know they have to service 1,000 flowers in a day just to eat their amount of nectar they need and then every night they go into a torpor where they basically shut their body down at night to be able to sustain.
Did you use that word service as like a euphemism? What do you mean that they service the flowers?
They have to get their beak wet. You know what I mean?
I got you. Okay. All right. I'm gonna move away from the weird topics, get us a little bit on topic. Jason, I took some heat last week.
Oh, geez, did you ever?
I got some heated replies. I was told that I am out of touch with the everyday man for saying that centimillionaires are like dragons hoarding gold. I don't want to get myself in more trouble, but I do find it astounding how much we as Americans will go to our grave trying to defend the 0.00001%. Look, I'm by no means a socialist, but the responses I think were unwarranted. And I think actually in discussing it with some people, I think there was a little bit of confusion about what I was trying to say, which I take full.
So you can rectify it now. Exactly.
Let me rectify. Because we were having a conversation around generational wealth. And the point I was trying to make was, to me, I don't understand the goal of generational wealth just for the sake of generational wealth, that I think it can be damaging. When I talk about generational wealth, I do not mean making $5 million so that you can dramatically impact the next generation and their ability to live in a better place, go to school debt-free, take certain risks that you aren't able to take. That can have profound generational impacts. I am talking about a family with $500 million to $1 billion where the next 5 generations don't even have to work, right? So when I talk about generational wealth on the last episode, I do not mean working hard to improve the generation after you. I think that is incredibly admirable. I think everyone probably strives to do that. Anyone with children has that immediate desire to try to make life better for their child. What I'm talking about is the goal in and of itself to just make $1 billion so you can retire your great grandchildren. I think there's, in my opinion, I don't understand that desire. That to me is a very foreign thing. So I just wanted to clear the air. When I talk about generational wealth, I'm not talking about, and I don't want to make light of how much money $5 million is, $10 million. I'm not talking about those aspirations. I'm talking about in the world you and I live in, we see absurd amounts of wealth. Families that really will not have to work for generations, and they could squander a bit of money and still not have to work for generations. And that can be and has historically been incredibly damaging to the later generations.
So there's so many things you said in there, but I want to start with you and I each had probably 12 different separate DM threads or a dozen separate DM threads about this episode and what you said. So if any of you think we're talking about you, we're probably not.
We're definitely not talking about you. We're talking about all of you.
But like
not you specifically, it's everyone.
But I think the main key point that you just pointed out was like in your head, you were thinking the 500 mil. You're not thinking of somebody putting together 5 to 50 mil for their family. But even that leads to a lot of interesting things. Like the one you just brought up that I thought was interesting as well is how much we defend the 0.001% in this country because families are always rising and falling in America, right? And we always have the aspirational idea that one day we could be in the 0.001%. So it's interesting how we defend the 0.001% because we aspire to be there one day. So we're almost like building the moat before we even get there, even though that moat is precluding us from getting there. So there's a lot of, I think part of the conversation that's more fascinating to me is the amount of paradox that's instilled in this conversation, because I've had conversations. I remember we're having actually a conversation at Tilly's, one of my favorite places in the world, which is ironic to have a conversation like this. And we were talking about how, wanting to provide your kids with that kind of wealth or whatever, you're inherently saying you don't think your kids can make it. Like to me, at least, like you're saying, I think you need crutches. And I think subconsciously the kids see that. And this is why we have, like you're saying, like shirt sleeve to shirt sleeves kind of thing where the third generation destroys it, is you essentially treat your kids like, like they're veal, right? Like they can't, or they're like a Wagyu beef in Japan. And then so you wonder why this gets destroyed over time. So like if you want to build that family office, and when we're talking like that 500 million, $1 billion level or whatever, you better make damn sure you're spending just as much time on educating your kids and working on their business skills, et cetera, investing skills, to make sure you're not creating those crutches and therefore relegating them to basically an ineffectual life.
Yeah, one of the things you tend to see in those situations is the later generations feel like their ability to have an impact has been robbed from them, right? They often end up going into more social and charitable areas because they can have a real impact, whereas the family wealth is so large, all potential achievement in the business arena is taken away from them. Right now, you would think, hey, with that sort of financial backing, you can take some mega swings, right? You could keep going for grand slams pretty risklessly, but you don't see that happening. They sort of feel robbed of the ability to have any material impact on the family wealth, and so they end up going into more charitable or just sort of drifting away from the family entirely. It's incredibly complicated. I mean, you go in, anyone who does financial planning with families, right? You talk about things as complicated or as simple as leaving a family house. There's a cottage on a lake, leaving that to children, and how disastrous that can be for the children after the parents die and destroy families, even though it's meant to be a great legacy. Money is an incredibly complicated topic and gets more complicated the more parties that are involved. So I think there's a fine balance, right? Again, to me, if you are a person who came up with nothing and your goal is to set your children, live in a better town, surround yourself with better people, provide your kids with an education, give them more stability than you had, like that does have profound generational impacts in a very positive way, in my opinion. That is true generational wealth that I think is worth aspiring to. Not what I was talking about. I was talking about like the billionaires.
Well, I got a lot of in my text threads, a lot of exceptions to the rule where people are pointing out these people are better off and everything, but we also, that's survivorship bias. And as you and I've seen, whether, serendipitously and fortunately or unfortunately, we're in a lot of these rooms, you've heard me talk a lot about it privately in some of these rooms as well, is that I feel bad for people that have a father or mother who was so successful that they created this multifamily office or et cetera, because now the only way they can feel good about themselves is to exceed that if they go into the business or investing realm. And we've just seen so many people just absolutely destroyed psychologically on that anvil. And there's so many people I know too that are running hedge funds that try to build multi-generational wealth, where their kids are, on the street and they're heroin addicts or now fentanyl addicts. And so like you just, money can solve some money problems, but it doesn't solve all your problems. And so, but once again, we're talking about a very nuanced thing here, where sometimes we're in these rooms with these billion-dollar family offices, and it's just a little awkward to be around. But like but I love that you stepped into it. At least that I got to be like, yeah, Corey's an asshole. I'm just joking. I was defending you the whole time, but like I was talking about nuance. But we were talking about the paradox, right? The paradox of wanting your kids to have a better life than you had, but realizing that what you went through is what made your life possible. And the stand-up comics talk about this all the time. It's like they talk about stand-up comedy comes from fucked up people that have fucked up childhoods. And so like, can you have a good childhood and be a great stand-up comic? Of course it's possible. There's going to be exceptions to the rule, but we live in a world of paradoxes. And I think it was even on one of Jim O'Shaughnessy's recent podcasts, he had a writer on, and I think he writes about like everything is bullshit, but he's like talking about paradoxes, right? Like especially paradoxes with social signaling, right? We try to social signal that we're not interested in social status because that will confer social status upon us. And like we try to pretend that we're not into money because by pretending to not be into money, it's likely that you could raise AUM or whatever it is. Like we just deal with these paradoxes all the time. That we're running these scripts all the time in our life, and we don't realize what we're doing to ourselves.
I love that. I love that idea of the paradox, especially around money, right? The only there's a luxury in not being able to afford to think about money. That means you have a certain amount of money. The less you care about money,
right,
the more money you're signaling you have in many ways. Yeah, it's fascinating. Well, I will say,
speaking of which, my dad like always never cared about money, but he probably should have cared, or else he wouldn't have been that shirt sleeves to shirt sleeves.
Well, I will say that wasn't the only thing I kind of got myself in trouble in last week, this week. I was privileged enough to get to speak at a conference yesterday, Democratized Quant, put on by Wes Gray, an Alpha Architect, and I was invited to be a discussant. So this is a pretty cool conference. I think most of the conferences you and I go to, at the risk of never getting invited to a conference again, they're pay to play in many ways, right?
Yes.
There's sponsors who buy their way on to panels. I've been fortunate in that I've been invited to speak on a number of panels without having to pay. But they're often like weird product pushes, and I always feel like they're not really all that valuable from an educational perspective. What Wes and his team have done with Democratized Quant for years is they have brought the academic format of a conference to finance. And so the idea is that someone gets up and presents a research paper or a research topic, and then there is a discussant. And the discussant's role is to summarize the key points of the paper, the takeaways, really sort of highlight the important parts. So to make sure everyone keyed in, right? Sort of re-communicate the key points so that if people weren't following the paper in the first place, they could sort of reinterpret it. And then also highlight any potential concerns or areas of conflict within the research or things that they think could have been improved. It's not meant to be combative, but it is meant to be, ideas need to stand on their own. It's nothing personal, but we're here to discuss ideas in an academic way. And Wes reached out to me a little while ago and said, hey, I'd really like you to be the discussant for this research affiliates paper called Reimagining Index Funds. And I knew he was setting me up to jump on a grenade because I'd already read the paper. And I don't want to say I didn't think fondly of it, but I had my concerns about it. And then as I dug deeper into it, I had more and more concerns. And so during the Democratized Quant conference yesterday, as the discussant, I spent probably 90% of the time explaining why I thought the paper had some big potential issues with it. And I don't think it was well received by the participant from Research Affiliates. And then I kind of doubled down. I've tripled down now. I wrote a blog post about it. I wrote a Twitter thread about it. Research Affiliates has actually I just saw before this, replied to my tweet thread saying they'd welcome a discussion at what'd they say, a more appropriate venue. Because I guess Twitter is not the appropriate venue to discuss these things.
But your discussion at the quant conference in long form was not an appropriate venue, or?
I guess not.
But so, okay, before we get into the details of the paper, once again, paradox, right? You got to live this. Allegedly, the point was to Carneades this and argue both sides so people could get a better perspective. And when you argued the other side, people were unhappy with it. It's like, what did you think you were signing up for? Like, is it supposed to be where you're supposed to straw man the other side and still make sure that all the quants are happy? Like,
I know.
What's the point?
I don't know. I will say this time, instead of getting like angry DMs telling me I'm out of touch, I actually got a lot of DMs from people saying they really appreciated that I wasn't pulling punches, that I was willing to engage intellectually and not speak down about the researchers, just say these are things that I'm seeing in the research that I think might not be what the researchers intended, or I don't necessarily agree with their explanation. I think there could be something else going on here that warrants further review, but that's not always taken super well in this industry, right? Like when you spend the time to write the research and you're submitting to papers, and look, I don't want to like skirt around this issue. Most of these papers are fluffed up marketing. Like they're selling a product at the end of the day. Like they had launched a product based on this research that they then wrote a summary paper. So for me to say, I think the research is wrong, or there's a big potential hole in the research that wasn't considered by the authors, it's kind of a direct attack on the product, right?
Yeah, no, that's a good point. By the way, was this the conference where you were supposed to defend the value momentum spread or whatever, not mean reverting? Isn't that the one you volunteered? Was that for this one?
No, I definitely. Someone tried to volunteer me for that, and I said I'm absolutely not doing that because I'm pretty sure Cliff was on the other side of that conversation, and I was not about to tell Cliff Asness why he was wrong.
So, there's so many things you brought up in there that excite me. One is, it's a weird paradox. Once again, I'm going to keep talking about paradoxes today. Apparently, it's like, you know, when you do that research or you have a product or whatever, that's kind of your baby. So you obviously want to defend your ugly baby. But at the same time, people like you and me really want feedback to know if we're wrong. Like, what if I'm missing something? Like, I don't want to put my clients in here and I missed something that was, you know, maybe seemingly obvious to somebody else. And I've got a big hole in that. So you really want somebody to red team a lot of your stuff, but it's hard to do that sometimes when you're the creator or you're pushing that product, right? Because you're going to have a natural inclination of defensiveness. Like, think about like Danny Kahneman, System 1, System 2. Like it's fine to feel butthurt initially, but you should come around really quickly though to realize, oh, maybe there are some holes. Let's discuss this, and I can get a separate set of eyeballs for free. Because quite frankly, to me, you're doing an invaluable thing for them. Two, you said. I love that we're just going to rip off the Band-Aid here. It's like most of these conferences are pay to play and they're absolutely pointless and everybody's just circle jerking each other. And we'll get to the conference maybe we're going to next week as well.
But can I just caveat that? Like, yeah, the conference itself in many ways,
a different one. Yeah,
often is like, and not saying any particular, but conferences in general, like what's actually on the agenda, I find most of the time isn't worth going to. Hanging out in the lobby is absolutely worth going if you're trying to do business, because everyone will go to some of these so if you pick the conferences you're going to, they can be priceless. But I'm not like, when I'm going to these conferences, I'm going and I'm setting up meetings all day. I'm not going to listen to panel speakers necessarily.
Yeah, it's always those when you dip out of a speaker and you just go to run to the bathroom real quick, it's on your way back, you run into somebody in the hallway, and those serendipitous meetings are the entire reason you go. And then three, I'll caveat this with, you and I obviously have a lot of quant friends. You know, I think you count yourself as a quant, all of that stuff. So, you know, always big fan of the quants, big fan, you know, this is my quantitative, all of those things. But at the same time, is, you know, I like to say you never go full quant. Or the other way I'll say it is like, what happened to you, I think, in this scenario is what does bother me about a lot of this quant stuff, especially when we start talking about like factors and all these different equity quant metrics, is everybody's essentially just torturing crisp data, right? And what I find is if you're torturing crisp data, you're likely torturing 100, 150 years of data. And, what you really don't know is that just one data set, right? Like, as I've talked about before, with the advent of the Industrial Revolution, we don't know if that last 150 year period is an anomaly. When we went from 1 billion to 5 billion in the workforce, we won't see that kind of 4x, 4 or 5x happen again. Likely. Well, I don't know, what the future holds. But then part of it is, okay, over that time span, like, for example, we were talking about the value momentum spread has to mean revert. It's like, it doesn't have to. The other thing is, like, if you only have 3, 4, 5 to 10 instances over that 150 year period where you think your models have found a factor, anomaly, a mean reversion, whatever, a momentum play, like, that's not enough data. And what's interesting to me is, like, quants are very specific about having enough data and have something that's statistically significant, yet all of the things they usually put forth are not statistically significant. So my theory is that in a way, you don't have the data you actually need, or the amount of iterations you would have to need to draw conclusions. So there's a form of religion to quant. And quants are going to get really upset with me saying that, because no, it's just math, it's just numbers. No, there's a lot of religion and faith involved. And that's why I think they get so upset if you question the orthodoxy. And quite frankly, there's a lot of quants on FinTwit that are assholes on FinTwit. And I think part of it is just like every religion, like if somebody attacks your religion, you just go hard in the paint at them, because it's all faith-based. And what you're really scared of is people seeing that the emperor has no clothes.
Well, so I think where quants would push back is, you say it's not statistically significant. They would say it absolutely is statistically significant. And they show a bunch of numbers to prove it. They'd give you a bunch of p-values, right? T-stats. Right. I think what you would say is the way they're measuring significance is wrong. Like the way they're measuring independent observations is not correct. Their N is way smaller than they really think it is. And I don't think you're wrong. Particularly when you talk about like the slow frequency quants, when you're talking about the value factor, even something like momentum, stuff that is going to have a Sharpe ratio of 0.3, 0.4 that can go through a decade-long drawdown from a statistical perspective very easily. Those things take a large degree of faith that they are going to work out over your investment horizon. Right. And I think it's hard to argue otherwise, right? We've sort of backed ourselves into a corner as quants, at least the way we've measured things historically. I wrote I'm going to call it a paper. It was really just a blog post, pseudo research note a couple of years ago called Factor Fimbulwinter. And the idea is that, people always think of factors blowing up, which I said was Factor Ragnarök. Basically, like when a factor stops working, you would think all of a sudden you earn a negative premium and it's going to be very obvious it doesn't work anymore. The reality is, when a factor stops working, it's just going to become noise. It'll work sometimes, it won't work other times. You'll lose on transaction costs on average, and it's just going to be noise. So the difference being Ragnarök being the Norse mythology end of the world, big cataclysm. Fimbulwinter is the period before Ragnarök that's just this never-ending winter. And my point was, when factors die, it's Fimbulwinter. Like, you don't know. And if we have 100 years of data supporting the value factor, it might take 50 or 60 years of the value factor going sideways for us to collectively go, it died, right? From a pure numbers quantitative perspective, you look at the size premium. That's exactly what just happened. Went 30 years without any real material size premium emerging, and people went, no, you know what? Maybe this thing actually isn't real. Turns out maybe we don't believe in the size premium anymore. So I 100% agree. Like, for the slow style premia that a lot that gets packaged up into ETFs and mutual funds, there is absolutely a faith-based part of it. I think that's why a lot of my peers have moved to mid-frequency to high-frequency trading, because the feedback loop is so much faster. When I talk to really the big multi-strat firms, they have all moved to having a significant proportion of their alpha coming from, forecasting over a 1 to 5 day period. They're not trying to forecast over a 40, 50, 60-day period anymore.
Yeah, but there's part of that. I mean, Exhibit A, like you just said it much better than I ever could. As typically you're much more eloquent.
Well, we're playing at my home turf here, bud. I mean, this is my comfort zone.
Well, and I'm accidentally not, kind of shitting on all your cohort, but at the same time, what I find, especially when we talk about those slower factors like value, as much as I, have so many value friends and everything too, it's like there's a certain amount of, once again, paradox. There's a certain amount of smugness, right? Like all the value people try to come across like, oh shucks, I'm just a guy that likes to buy, things at a deep discount with a margin of safety, and I'm just a value investor like Buffett. Look at me, I'm a cuddly grandpa. And then bullshit. There's an amount of smugness and everything on FinTwit that drives me crazy with a lot of people that do slow factors, whether it's value or other things. And it's just like, there's a paradox. I mean, everybody knows that, like, and nobody wants to say that, like, Buffett and Munger are kind of smug cunts, like, but nobody wants to talk about that. Like,
Clip it, Tyler. Clip it. Clip it and flip it. That thing's going to get you canceled.
Well, I mean, I'm surprised it's taken this long. So you brought up higher frequency trading, which I couldn't agree with more. Like you want more iterations, more at bats, and then you have more statistical significance. So one of the other things that you had, I don't know what feedback you got because we haven't really talked about it, is you had Doug Colkett on your podcast on Flirting with Models. Great podcast. Talked about MEV and a lot of things, crypto or high frequency trading related. But it was funny when he's talking about MEV and he kept saying toxic flow, and then you ask him to find it at the end. But just for those that know, it's like, this is fascinating to me. It's like non-toxic flow is like your retail traders. Like everybody wants to buy Robinhood's flow because it's called non-toxic flow because everybody's just punting, right? Where they don't like toxic flow, which means it's a euphemism for professionals. They don't like other pros at the poker table, and so they get upset about toxic flow. And I think it's really fascinating. And so it made me think of the obvious analogy is like you and I are about to go to a conference next week in Las Vegas. And it was funny how, high frequency traders or MEV traders on minor extractable value on crypto, just to clarify what I'm talking about, is there's the analogous to the casino, right? If you go in a casino and you count cards or whatever, they're going to kick you out immediately. They want that non-toxic flow, somebody just getting drunk and just wasting their money at their table so they can get their pick.
They want you to drink the toxic flow. So you become the non-toxic flow. Yeah. By the way, little story time on my podcast. I am scrambling mid-season. My artist completely fucked me. So this is what I do. Look, I know a lot of people would say from a branding and marketing perspective, you should have a consistent visual theme. Flirting with Models is a special podcast, Jason, and I decide to forego that. And my theme is I have no theme. Every year I come up with a new cover concept and I hire a new artist and I do 10 to 15 covers for all my guests. And it's worked out for the last 5 seasons. I found a great artist for this season. Started coming up with covers 8 weeks before the season launched. And they got delayed and delayed and delayed. So if people were to look now, they would notice that Doug, his episode launched without a cover. It just launched with the generic season cover, which is me. And it's because my artist delivered an unsatisfactory cover on Sunday night when the podcast goes live Monday at 12 a.m. And I had to ask for revisions. And then they didn't deliver the revisions on Monday. So I canceled the future orders. I was like, I can't work with this person anymore. I gave them 8 weeks to get this done. They then, because I canceled the future orders, said, I've decided I'm not working with you anymore and canceled Doug's cover. So this was a bad idea on my part. This was really dumb to cancel without getting the final version. So then all of a sudden I'm like, I have, of the 15 covers I need, I have 3 done. So I'm mid-season, and I'm like, I don't know what I'm going to do. So I had to go back to last season's artist, who is fantastic. I should have just gone with him in the first place. And so he's cranking out covers for me at a rapid pace. So I'm really happy he was available. But, man, it's not going well, Jason. It's not going well.
Did you see what Tyler did to you in the top corner?
Yeah, he put my cover there. Yeah. I got to tell you, it's a pretty sick cover.
Yeah. Well,
I always just like me.
Well, at the beginning of the Doug one, you even said like all your marketing friends tell you not to change the theme every season, and I love that you change this theme every season in general. But I also want to point out
breaking the rules.
I want to point out that you put me in the hole once again is like, going first on this season and, having me jump on the grenades like Saving Private Ryan is that, at the end of Doug's and the other ones, you go, on this season, we're doing tarot cards and you chose this. So tell me why you explained. It was like, we did our podcast without even knowing what your theme was this season.
I
and
know.
So there's zero explanation there.
Well, you just dressed up like the fool. As always, Jason, you play the fool for me.
Right. And I don't think it requires any explanation either why I would choose the fool card.
I'm actually kind of waiting to see if someone's like, you're not allowed to do tarot, because I know nothing about tarot. I just thought it was really cool. I just thought they made like very cool designs and people could sort of pick a background and concept that aligned with them. But I'm waiting to get like canceled culturally.
Like an appropriation,
appropriation thing
for tarot. Wow, I haven't heard that one yet.
Well, hey man, it's a brave new world.
I know. I'm trying to think of like I was just my brain was trying to go like where and why and how that.
So I do want to go back to this research affiliates thing really briefly.
Oh please,
because I don't necessarily know if I want to go through the whole concept, but
tell us like the gist of the paper.
Yeah. So all right, let me really quickly try to get through this. What research affiliates was proposing, and I think it's in concept a very interesting idea, is most pure indexes are market capitalization weighted. So they choose securities. Like if you want the top 1,000 securities, they look at the entire reference universe. They find the top 1,000 securities by their free float adjusted market cap, and then they weight them in proportion to that free float adjusted market cap. The benefit of that.
I don't want to stop you right there. I don't want to interrupt you, but I have to. You just said float adjusted market cap, but you started with market cap weighted, but it's actually float weighted. And I think people miss that a lot. So I want to just point that out.
Most of the time it is float weighted. I'm just going to say market cap weighted.
But that difference is that it is quite a bit of difference.
Yeah. It can be an absolute. Yeah. But the idea there basically being, for the most part, you want depth and liquidity, and you're scaling according to size, and under certain assumptions, that is what the efficient market is. That is how the appropriate prices for securities, and you want to own them in that proportion to own the market portfolio that aligns with the efficient market hypothesis. The problem that they propose is sort of twofold. One, if you don't believe the market's efficient, that construction is very sensitive to noise, right? Particularly in the valuation component and sentiment that shows up in price changes. If you get price changes up and down that have nothing to do with the underlying fundamental changes of the business, you can get index additions and deletions that are just noise trades. You can also find for certain indices, something like the S&P 500, that you end up with sort of price influencing committee decisions, and that you can end up basically selling securities after they're massively depressed and buying securities after a massive run up. So the proposal they make is, look, market cap weighted ends up being a buy high, sell low when you talk about additions and deletions. And the way additions and deletions work is that they're well telegraphed, which allows the index managers to do a market on close order to make sure that they perfectly time their purchase and sale with when the index is reconstituting, so that they can keep their tracking error as low as possible. It makes it look like there's zero cost to the addition or deletion because they will track the index. The problem is, by being well telegraphed, that flow is front run. And so you actually end up with what the authors argue is about 20 bips of annual cost from index additions and deletions. So if you could come up with a methodology that avoided that unnecessary additions and deletions from these, sort of sentiment noise and valuation change, one and the same, arguably, wouldn't that be a better methodology? And what they propose is this idea of economic footprint. Buy companies choose the companies based upon their fundamentals of the company, which are going to be more stable over time. And then once you've selected those companies, you can weight them in proportion to their market cap. And the idea basically being, by focusing on company fundamentals, you avoid pure bubble stocks. You're going to end up with something that looks probably more like a value tilt, slight value tilt, but it should at least be proportional to market cap. So you get deep liquidity and high capacity. And what they find is that index has 20% less turnover. than the S&P and the Russell 1000. They find that the tracking error of that index to the S&P 500 is actually about on par with the tracking error between the Russell 1000 and the S&P 500. So it's not a huge amount of tracking error. But weirdly enough, and this is where it gets weird, when they run a Carhart-Fama French 4-factor model regression to try to explain the source of returns, they get this big alpha component. And it shows up with a very small loading on value, very small loading on size. They just end up with this really good looking alpha. And I think the suggestion within the paper is this wonderful alpha comes from reducing the turnover to avoid all of this unnecessary front running costs that can happen. And this is just a better construction that's more liquid and we get a little bit of value tilt. That is the proposal. I hope I haven't butchered it. I apologize if anyone from Research Affiliates is listening that thinks I've misspoken about the research. That's not my intention. Regardless, as a quant, I kind of looked at the paper and scratched my head and said, well, that sort of smells like bullshit to me because there's no way those index additions and deletions could add up to being as much alpha as they claim it is. And what they're claiming to do is add a value tilt, and yet there was almost no value tilt that showed up, which is a concern. And then they just have this big alpha. And look, I know everyone's looking for alpha. I think we need to reframe ourselves. Alpha is just unexplained returns. Like that's to me is not always a good thing. You want to know where it's coming from, and they don't really propose where it's coming from.
Man, you just front ran me on all those. Like I was just like that. That was my questions there. Like, so you said there was about 20 bips from the iteration, like from additions, deletions, getting front run. It was 20 bips annually or 20 bips quarterly or
annually, I believe.
So that's what I'm saying. Like, how did you turn 20 bips into an alpha? But also, like, you know, with the caveats around alpha. But
so
then,
I think the alpha was like 30 to 40 bips. So again, like
okay.
if it's 20 bips for annual turnover and you're cutting the turnover by 20%, that should be you shaving 4 bips off, not 4. Like you don't get 40 out of that.
Well, also, like we spend our lives like chasing 30 bips alpha over decades. But also, like that's why I was like, wait, you were telling me about the front running, the additions, deletions, and how the index is constructed, and then you took a hard right turn to talk about fundamentals and value, and I was like, what does that have to do with those rebalances?
Well, because I mean, the whole idea, right, is if you are so not only are you avoiding the rebalances, but the rebalances that you're avoiding are the buy high, sell low ones, right? Tesla came into the S&P 500 way after its run up, right? If you did things based on the economic footprint, you would have bought Tesla way beforehand. The stuff that got I think it was a REIT or something like that got sold in exchange for Tesla was massively depressed. Well, why did you sell it after the price went down? You should have retained it based on its economic footprint. It was a value stock. So their argument is twofold. One, we cut down on the turnover. It's a more stable measure. Two, the stuff where we do have turnover is not going to have this buy high, sell low problem.
Right. But to me, like, that's what I'm saying. You took a hard right turn and you started talking about like basically like equal weight index or evaluated equal weight index. And I was like, what did that have to do necessarily with those rebalances? I can see how you could stretch and say potentially that avoids that risk, but at 20 bips a year, who really cares? And then the other part of it is like you said, is like, wait, you said you tilted to more value equal weight fundamentals, but then like it didn't show up when you went back and did a factor regression.
I mean,
so
it
like
shows up very, it's like a very small tilt. Right. And now I think they might say, well, that's the tilt is the tilt. Like we are, yes, we're screening on economic footprint and it creates a very small tilt towards value. Here's where my quant spidey senses got tingling. They did a plot of the alpha. And you talk about all the quants are just data mining crisp. When you're a quant for long enough, you know what certain return streams look like. Mm-hmm. Like I know what the value factor looks like. I know what growth looks like. I know what their alpha profiles look like over time. And I'm looking at this alpha stream and I'm like, this looks for the first, there's like a 20-year back test of this concept. The first half looks identical to value and the second half looks identical to growth. And I'm scratching my head. I'm like, well, let's say somehow in their methodology, this strategy somehow went from value to growth. It was a heavy value strategy at the beginning. Some way it became a growth strategy. Well, that would mean that in the first half of the series, you had a positive loading on value. In the second half of the series, you had a negative loading on value, averaging out to having zero factor, from a full period regression standpoint, zero loading on value. So that would explain that. And we know value outperformed in the first half. We know growth outperformed in the second half. If they managed to have that style drift, the alpha would emerge and be unexplained because it's style drift. It's timing alpha.
Do you remember the time series, like roughly, like when did it shift?
Right around 2009.
Yeah. So I wonder too, like, are you in the camp that like talks about basically that most S&P 500 index are essentially trend following a Momo? Like you're saying, buy higher. Like, I mean, I'll let you handle that before I keep going.
Yeah, that's a really frustrating one for me because like I get what people are saying. If you buy the market, the next day you own more of what went up and you own less of what went down, and that isn't that momentum. The problem is it's also the market. Like that, yes. The market is a factor. So yes. The whole point is momentum is what's residual to what's explained by the market. Like, so it's sort of frustrating. I'm like, yes, I understand that mechanically that sounds like momentum, but from a return regression explanation standpoint, that's not momentum. That's just the efficient market. That's the beta. That's what beta is. So
you led me perfectly there. No, because that's why I wondered the same thing. It's like after cataclysmic shifts like 2008, or we could have potentially had March 2020 that we didn't quite see, is that index, it has to go through a violent phase shift, but then can switch back from Momo back to value, right? Because it's going to be whatever the constituent of the market is. And right. So they, like you said, if it was tracking that and like you said, turned in 2009, I think that's kind of obvious. Yeah. Like that's what the market was like. And that's, you could reduce the market to those factors or regress the market to those factors depending on when we have phase shifts. So even if we've been in a more Momo style S&P index, market float cap weighted, like it's going to take a cataclysmic shift and then it'll be pretty value weighted, moving forward after that for a while.
Yeah. Is that fair? Well, maybe, but that wasn't really what happened here. Yeah. So as far as I could tell, right, this whole idea of an economic footprint, they argue breaks the link to price. Like you're buying a company. What the paper read like was like, we're going to look at the sales. We're going to look at, total dividends paid. We're going to look at the book value. What they really do is they look at the book value relative to the aggregate market book value. They look at their revenue relative to the aggregate market revenue. And what's weird about scaling it relative to the aggregate market economic footprint, when you do that, is it actually reintroduces market cap weighting. I'm not going to discuss the math. I need spreadsheets and digits and all that sort of stuff to derive it for you. But long story short, economic footprint, if you do it the way they did it, is actually a multi-factor screen. It screens things based on their market cap, and it screens things based on a value tilt. So what I did is I said, okay, let me try to replicate this. Do I think I replicated it precisely? Like, are my numbers equal to theirs? Absolutely not. But it doesn't affect the logic of what I did. And what I found was that by definition, they will always sell larger cap glamour stocks to buy smaller cap value stocks. Like, definitively, there's no argument that is how the process works. So I said, okay, there is absolutely a size value tilt happening in this process. Like, how does it not show up?
Right.
I said something very subtle at the beginning when I was talking about their process. I said they screen on economic footprint, and then the stuff that's left over, they market cap weight. So
yeah. So like, okay, sorry. Let me jump in real quick. We always are changing nomenclature and euphemism. So is market footprint just another way of saying size?
Economic
footprint, sorry, is another way of saying size, right?
Well, size in theory, they're trying to measure size of the company, right? So instead of size of the security, right, which would be market cap, they're trying to measure the size of the underlying company. So it's like this, book value, revenue, cash flow, and total dividend distributed. And they do some adjustments in there, but those are the 4 basic metrics they use to try to figure out the economic footprint of the company relative to the aggregate market economic footprint. And then, so a company with a bigger book value relative to the aggregate book value of the market is going to be a bigger, economic footprint. So what happens, though, here's what's weird. Let's say we look at the S&P 500 and we screen out the stuff that has a lower economic footprint to buy the stuff that has a higher economic footprint. I told you that definitionally has a value size tilt. The stuff you buy is always smaller from a market cap perspective than the stuff you sold. Why is that important? Well, if the S&P 500 or the largest 500 companies right now have an aggregate market cap of like 44 trillion, the stuff you screen out today would be like 4 trillion. So you have about 40 left over that you kept in. 4 trillion gets screened out. The stuff you buy is like 1 trillion. Which means when you reweight that 40 trillion, adding in that new 1 trillion, the stuff you kept actually gets bigger. So Apple, Amazon, Google, Microsoft, which don't get screened out, all increase in size. And if you plot their weight over the last decade, you actually ended up overweight mega cap tech names because of this second renormalization step. So yes, there was a value size screen, but that second renormalization step actually made it so that those mega cap tech names got bigger. Why didn't this happen in 1999? Well, it has to do with how many names are getting screened out, and the stuff that remains, how value oriented was it? In 1999, there was so much dog shit that had zero economic footprint, but was a big market cap. There was like 40 or 50% of the S&P 500 would have been filtered out. And the stuff that remained had a strong value tilt. Today, if you do the same thing, only about 20% of the names would get filtered out. And of the stuff that remains, most of it has a growth tilt. So you're taking the growth stuff and making it bigger. And so this renormalization step that they introduce, and I don't think this was an intended effect, ends up over time, at least in my opinion, I could be completely wrong here. I don't think I am, but I could be, creates this style drift that the index started as value and became growth. And it's hard to say what it will be in the future. And I don't think that was an intended impact. And I think all the alpha is attributed to this style drift timing that worked out in their favor.
So it's interesting how it comes back to a style drift timing with mega cap tech. Like, I'm sure you've looked into it, like Vincent Delouard and others have brought up how like ESG basically filters down into mega cap tech because they have the lowest amount of employees like per revenue. And that's how it just filters to the top ESG.
All mega cap tech.
Yeah. The outperformance of ESG is just built off of mega cap tech, which is always ironic. There's a couple of things you also made me think about. One is the amount of brain drain in the quant community to try to beat the index by 20, 40 bips and for have something that may work, may not work is just insane to me. Like, what is, I mean, but that you see that all the time. It's like, this beats the index by 50 bips. You're like, okay. But then you're also like benchmarking off the index and all that stuff.
Yeah, I mean, but the economic incentive is massive. Like, well, think about how big the S&P 500 is. Imagine if you said, I can do the S&P 500 plus 20 bips with all the capacity, and you raise $1 trillion. Like, even if you're charging 2 bips for it, you're making bank.
But like what you also said earlier, though, related to factors too, it's always interesting is like, especially the slower factors, like it could take us decades to realize they don't work, even though we think they, and usually what's interesting to me is always we're at that inflection point, right? For you to see a slow factor and have some confidence that it works, right? It has worked for the last 4 or 5 decades, almost like 60-40, right? But you don't know if you're buying in right at the peak before it declines for the next 4 decades and you end up break even anyway. So you just never know. And part of that was, I went actually this week. I went and re-looked back at Joel Greenblatt's Magic Formula. Do you remember that book?
Yeah, absolutely.
And it was interesting. And once again, his data from the time of the writing of the book, it showed like tremendous outperformance. I want to say it was like a 30% CAGR or something like over the time frame they looked at. And then of course people are reviewing it now. And since the book came out, like it's been underperformance. Like for like, let's just say, I don't remember the exact years, but directionally correct. Let's say it underperformed for a decade and underperformed speaking to the an S&P benchmark. And then non-ironically, it's come back in the last few years, and which is exactly what Joel Greenblatt talks about in his book. He's like, if this outperforms, why wouldn't everybody do it? Because it doesn't outperform every month, every quarter, every year. And that's why people won't do it. But it's hard to know moving forward, right? That you're playing that guessing game, and you have to go through the emotional turmoil of trying to hold the faith. What I'm saying, this kind of faith-based.
Yeah, it's absolutely faith-based. I mean, it's just, I think quants would say our faith is in the numbers, and our faith, a lot of these slower factors, quants try to prove out who's on the other side. Like they try to come up with an argument. Is it a risk premium or a behavioral premium? And figure out who's actually taking the other side of this trade to figure out if it is long-term sustainable. Tons of work has gone into that. Quants will often also show, hey, this doesn't just work in equities. The concept works in bonds and commodities and currencies. And oh, by the way, it doesn't just work in the US. We export it on data, and it works in France and Germany and Japan and China. So the quants do try to take these slow factors and build alternative data sets to test their hypothesis. They do try to have a good intuitive understanding of why it should work. But I don't know. It's the same. It's not the same, but in many ways, it's related to just like, why do we think the stock market will go up? Like one is a P&L based argument to a certain degree, like all the style premium are trading strategies. But with something like, well, why does the market have to go up? You're counting on over the long term on getting compensated for bearing the risk and some economic growth, right? Like that's ultimately what you're getting compensated on.
I just want to press pause for a second. Are you questioning ERP?
No, I think the ERP exists. It just doesn't have to realize and be positive, right? You can have a lost decade in stocks very easily. You can have a lost 20 years, 30 years, right? Exactly. The ERP is expectation. And expectation can still be positive, and a realization can be negative. You're not going to get me on that one, bud.
If ifs and buts were candies and nuts,
okay. Can I change the subject to something a little pudgier, a little fun?
Oh yeah, I got you. Yeah, please.
So Pudgy Penguins, the NFT, everyone's favorite NFT of penguin cartoon JPEGs. So went through, I'm not going to go through the history of it, but basically a big change of control. It looked like they were crashing as an NFT, right? Everyone's laughing. Oh, you spent a lot of money on JPEGs. This person comes in with the vision of how to turn this into a global consumer brand. And just yesterday or 2 days ago, launched a full line of toys, all digitally connected. That, if you buy a toy, you get a soul-bound NFT to a digital wallet, and you can swap and play with your toy. I think there's going to be future game integration. I mean, I think to me, it's really fascinating about how these NFTs are getting tied into real-world products. What I haven't figured out, and I dug reasonably deep last night before I got distracted with having to care for my child, was the royalties.
Your real life Pudgy Penguin?
Yeah, my real life Pudgy Penguin. The royalties getting paid to the Pudgy Penguin owners, right? I heard rumor that it was like 1% gets paid to the Pudgy Penguin owners whose penguin was actually licensed, because not all the penguins got licensed. But it is this interesting argument of, okay, first of all, when does it become a security? Right? If you're licensing the likeness of an NFT you own, is that a security? I don't think so, but I'm not a securities expert.
Could be, yeah, licensing the collectibles. I'm sure the way getting around it. But like to your point, though, you said Pudgy Penguins are set up the same way as Bored Apes, that like you actually own the IP to your individual Pudgy Penguin.
I believe that's right. So anyway, I think it's just a fascinating story. For years, people shit on, why do you own NFTs? Not me in particular. Why would anyone own NFTs? They're just JPEGs. And you're starting to see people are using these JPEGs to launch toys and video games. And there is a royalty stream that's getting paid back to the community. It seems kind of insane. It's like, well, why not just do it? Why not launch a whole new 10,000 penguins? And why pay the community anything? And I think part of the argument is like that the community is what really grows the market share. It's like having a very invested 10,000 person marketing team out there talking about this stuff and sharing the culture and trying to promote it, because they're financially incentivized to.
Yeah, you have your first mover fans, like, that are gonna, push it larger than you could ever, like, trying to start it again from scratch. But also, I think it was on a few weeks ago, Tim Ferriss had Bobby Hundreds on his podcast, and obviously Bobby Hundreds is still very bullish on NFTs. So, like, you're seeing this Pudgy Penguins come out and everything. Are you starting to get bulled up on NFTs again, or always still the same?
I'm always still the same. I have some projects I like. I flip where I think it makes sense. I just haven't been, honestly, I haven't been paying attention. I think NFTs just actually got taken out behind the woodshed a couple of weeks ago. I think it's been pretty rough for most NFTs other than Pudgy Penguins lately. I think there's some really fascinating projects out there. I think people really do overlook the space and they say, oh, it's just a JPEG. I think there are some projects that are doing far more and there's real economic incentive for owning that. Again, I dabble. It is less than 1% of, my liquid net worth. So it's like, okay, if I lose it all, it's not the end of the world.
So, do Pudgy Penguins have a promise? Because around here we have a pirate's pinky promise. You're getting that 3P.
Tell me about that.
Yeah. Yeah, so it's not crazy. I mean, we sit here and we entertain you while I have two unbelievably red eyes due to bacterial, red eye. And then, but all we ask from you in return is that you go over to YouTube and you smash that subscribe button. We don't care if you only listen to us on audio. We're cool with that. I mean, it'd be nice if you left a review on audio, but we prefer you go over to even to YouTube and hit that subscribe button on YouTube. That's our pirate pinky promise. That is our promise to you. Doesn't require Pudgy Penguins. Doesn't necessarily require Pudgy Pirates that I'm turning into. But it's just our pirate pinky promise between us and you. Now, related to that, Corey, as everything we say is not investing advice, I did notice.
Wait. Should we buy a Pudgy Pirate Penguin?
Oh, now you're talking. Now you're talking.
They exist. They exist.
Oh man, now you're gonna have me like looking through this afterwards like crazy.
We need a mascot.
None of this is investment advice, but I did notice. What do you think of Doug Colcutt? His being very bullish on Ethereum long term.
What I thought was fascinating is I have spoken to a lot of I won't say a lot, enough high frequency crypto traders that think the entire space is a complete grift, and they're like they're just in it to make a buck.
They're in it to grift their own grift on the grift.
They're like if there's gonna be gambling in the casino, I'm gonna try to make my money while the getting's good. I think Doug is a builder. It's very unusual for someone to have a long-term bullish thesis as a high-frequency trader. So I have a lot of respect for that. I mean, look, he's putting his money where his mouth is. He's not doing the high-frequency stuff anymore. He's spent considerable time and effort building out his own decentralized exchange, trying to. I don't know if you noticed in the podcast, I congratulated him on the pending launch.
Yeah.
The launch has not happened. My understanding is that being a doxed founder in crypto is not good because the regulators know where to find you. And so despite trying to dot your I's and cross your T's, the regulators can come in and say, hey, we don't like what you're doing. So I think he's working through some issues, trying to make the regulators happy with how he can launch as a U.S. individual, as a U.S. citizen. But yeah, I mean, look, he's clearly bullish long term on the ecosystem, or he just wasted the last couple of years of his life.
By the way, shout out to Lisandro and the Booty Crew. He's upholding his PPP from Barcelona every Friday evening. So
we love it.
We appreciate you. But like going back to what you said, obviously, if we have enough trouble trying to even get podcast art done, I can imagine trying to launch a DEX on time. Because yeah, you congratulate him because you're like, by the time this podcast comes out, it should be launched. But at the same time, like, how do you think about, like, I've always thought they came across a lot of times as like crybabies about regulation, but I feel like more recently that rhetoric has struck a chord with me of like saying, well, if the US is not going to address this at all, that we're just getting so far behind the rest of the world. And if you make it incredibly difficult to launch these products in a regulatory environment in the US, which a lot of them are calling for, then like, what are we doing? Like, and yeah, so I may have changed a little
frustrating. Bit. I think what's frustrating, and I don't know if you watched sort of the infamous Gensler tapes from a couple weeks ago, his interview. I don't mind regulation. I like regulation if it's appropriate regulation. Like you and I deal with regulation all day long. I don't think all the rules we're subject to are a bad thing necessarily. I think it prevents a lot of potential fraud in the space and does protect consumers. But regulation needs to be clear. And when Gensler can't tell you whether Ethereum is a commodity or a security or a collectible, and multiple people are getting sued and it's being defined by different regulating entities as different things, it makes it impossible to build, right? When you have the CFTC calling it a commodity and Gensler calling it a security, there's no regulatory body to operate under. And so that is incredibly frustrating for people who are trying to operate in good faith. And the only people you're punishing are the people who are trying to operate in good faith at that point. Because the people operating in bad faith are just going to do it regardless. The people who want to adhere to the regulations are the ones who are getting stuck because there's no regulations to adhere to. And so I think I find it to be, and I'm not a builder in the space, but I think it's an incredibly frustrating regulatory environment. And I am almost certain it will drive innovation outside the US if we don't come up with regulation in the short term. Or at least safe harbor rules. Like kick the can down the road and say, we don't know, but these are the safe harbor rules.
Just let me know who's going to regulate me under what laws and maybe kick the can down the road. But like, as you know, even with our regulations, just interpreting the regulations make it difficult too to run a business. But shout out to Lucius, first time catching us live. Appreciate the Pirates Pinky promise. With that, we're going to be out for this week. I mean, done for this week is what I meant. Not out. Next week, Corey and I are going to be at EQD in Vegas. If we know some of you that listen will be there, please say hello as always. Nothing we say is investment advice. This podcast is hopefully for entertainment purposes only. Hopefully we manage to entertain, but otherwise we'll be coming at you again live next Friday at 3 Eastern. Corey, do you have any? You're about to jump in there.
I was going to say the poll for next week.
What was the poll? What was
I don't know what the poll for this week is, but the poll for next week absolutely has to be who's going to have a better outfit for EQD.
Oh, see, this isn't fair though. If you're already planning it, I'm not even thinking about my outfits for EQD, and you're just trying to one up me already.
Yeah, but I saw your outfit for the Derby, so
I only have 3 outfits. That's, as you know, that's the secret. All right. With that, Tyler, please take us out of here. Thanks, everybody.